Welcome to this week's Real Estate Q&A, where I'm discussing highlights from the Federal Reserve's meeting yesterday on what to expect in regards to the housing market, interest rates, and the U.S. economy for the months ahead, as well as addressing questions and comments from our YouTube channel over the last week. And I'll also be discussing the jobs market that seems to be falling apart with tens of thousands of layoffs announced this week alone. Hey, welcome back. And if this is your first time watching, I'm Todd Sachs, the founder and broker of Sachs Realty and your host of the Sachs Realty podcast. And if you like it here, please consider subscribing to be alerted when we post important updates just like this. Well, the markets weren't expecting the Federal Reserve to actually stick to their word when they said interest rates would be higher for longer and that we must get inflation back to the 2% target. Maybe now rich bureaucrats will finally realize that most Americans are struggling to save money, not to mention those deciding what bills to pay in order to feed their family, keep gas in their car, and keep a roof over their head. Guys, prices are just too damn expensive. This is one of the reasons that we're seeing delinquency rates skyrocketing on credit card debt and auto loans. Now let's take a look at this chart regarding consumer debt from ycharts.com. So as we look at this chart, what we're really focusing on is in November of last year, the total consumer debt in the U.S. reached an all-time high of $5 trillion. That's trillion with a T. This is the worst debt ever seen in America. And look when it really started to skyrocket, right about August, July of 2021. So what I want to do is take a minute and expand this to the 10-year view. Even though it doesn't go back 10 years, they haven't been tracking it that long. But if we just look, guys, just look back in 2019, you can see what has really happened since the pandemic. So where does it go from here? I mean, I think we haven't gotten any better since November. We're always looking at backward-looking data, and probably this is what the Fed themselves are looking at. And according to Wells Fargo's November's consumer credit reporting, it showed a surge of about $19.1 billion, of which was mostly driven by credit card spending. I mean, what the heck? And in my experience, no matter what the Fed decides to do with lowering interest rates, these credit card companies, they're not going to drop their high interest rates on your monthly credit card debt, especially for those that are delinquent. And in this Bloomberg article, January 11th, 2024, titled Credit Card Delinquency Rates Climb to Decade High in Fed Study, it says that credit card delinquency rates have exceeded pre-pandemic levels, while the share of borrowers making only the minimum payment climbed above 10% for the first time since 2019, according to a Federal Reserve Bank of Philadelphia report. I mean, listen up. 10%. That means 1 in 10 at least with credit card debt are paying only the minimum payment due. I mean, this is a really bad sign for our economy. Now let's have a listen to Jay Powell of the Federal Reserve from yesterday.
But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago, but still strong. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers.
A supply of workers. Maybe retirees coming back to the market, or people getting second jobs, people coming across the border. Well, do you believe these job numbers? In this Yahoo.com article posted on January 6th, titled Initial U.S. Employment Reports overstated by 439,000 jobs in 2023, stating the government quietly erased 439,000 jobs through November of 23. A closer look at the numbers from the Bureau of Labor Statistics shows that means the initial job results were inflated 439,000 positions, and the job market is not as healthy as the government suggests. Now, let's take a look at recent statistics pertaining to the strong job market. This CNBC.com article says UPS announces 12,000 job cuts, says package volume slipped last quarter. This CBSNews.com article says Citigroup is planning to lay off 20,000 employees, or about 10% of its workforce, in the next 2 years as it comes off its worst quarterly financial results in more than a decade. The embattled bank on Friday reported $1.8 billion in losses in the fourth quarter of 2023, while revenues fell 3% to $17.4 billion from last year, according to its latest financial filings. The layoffs could save the bank as much as $2.5 billion, Citigroup's presentation to investors shows. Now, that's not to mention some of these other companies announcing layoffs from dailyjobcuts.com. Walgreens, NASDAQ, PayPal, Cargill, Nestle, American Airlines, TD Bank, Lockheed Martin, Walt Disney, Lowe's, Microsoft, Corning, Sports Illustrated, and by the way, they may be getting rid of everybody, and many, many others, with all of these layoffs announced in just the last 10 days alone.
Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%.
I'm sorry, guys, but why would you exclude food and energy from inflation numbers? So essentially, prices have declined on things that we don't actually need, but if you want food and utilities, then maybe we could just guess where the year-over-year inflation rate falls.
Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%.
What it appears we're hearing from Jay Powell is that there's no real intention on reducing interest rates too soon, despite any potential pressures that they may be receiving from the White House or banking CEOs to reduce rates now to re-stimulate the economy, as doing so could reverse any progress that we've made this far in reducing inflation. However, he did say that caution must be taken, as keeping rates too high for too long could also have a negative impact as well. So buckle up and get ready for a much slower economy, which may result in what could be a great recession this year. We're already hearing in the news about banking troubles as the results of higher interest rates continue to cripple consumers from spending money they simply don't have. And rates higher for longer won't help the housing market either. For those who work in real estate wishing for home sales to pay their bills, don't expect any miracles this spring. Unless home prices fall drastically or employers decide to raise salaries in their slow time, buyers simply can't afford the monthly payments with today's high home prices. Guys, in my humble opinion, home prices will drop for those needing to sell in 2024, and it may be a lot more housing inventory this year as some sellers have been holding out on selling for almost a year, and the economy isn't going to get any better. It's getting worse. And Powell said it best, the economic outlook is uncertain. And now for this week's comments and questions. All right, so our first commenter comes off a video that I made going to a real estate conference last week in New York City. And what I've been saying for many years now, especially since I've been a broker since 2017, is that many brokerages make their agents their clients instead of the actual buyers or sellers. And it never used to be that way in times past. But recently, last 10, 15, 20 years, it's turned more that way. And that actually is very disheartening for me because brand should matter. And what I made a comment, and we did a poll in our last Tuesday Night Live asking you, if you go out and you buy a shirt or a pair of shoes or a car or something like that, you typically buy based on brand, right? You'll look at reviews for the brand. Is the car reliable? Does it break down? Is there a lot of recall issues? But it doesn't seem that people do enough research into the actual real estate company that the agent is affiliated with. And to me, that's a big mistake, because if that broker or leadership in that particular company doesn't care about the actual client, they put the agent in front of that. I think this is one of the reasons why agents have such a bad reputation. But this commenter says the brand don't matter if they are more concerned of their split than they are providing agents training and methods to work a qualified business model. I'm going to tell you right now, we're going to see a mass exodus in this business as sales have dropped off big time. All the lawsuits that are in the news right now, I'm calling all the leaders in the real estate industry, brokers, to really get in front of this and start to realign their thinking. We need to be business to consumer, not business to agent. I think it's time that the public should expect more transparency and that the public should be looking more into the actual business and company and what their beliefs are and making sure that your satisfaction is job one. Our next commenter is also referring to our Tuesday Night Live that we just had with John Rubino, and we were talking about this buy now, pay later mentality. You just looked at the Y charts with me, the debt that's mounting up in America. There's no consequences for racking debt. People are just bailing on their, paying their bills, bailing on their student loans, repossessions in the automotive industry is through the roof. They actually don't have enough repo people to repo the amount of cars that are in default. But anyway, we were talking about layaway. Back in my day, when our parents couldn't afford to buy us something right away, they would put something on layaway. They'd go buy it, they'd put it in a back storeroom somewhere, you make payments on it, and then when you paid it off, you would get it. You would actually, get to bring it home. But obviously, credit card companies are flooding our mailboxes, even to our kids that don't even have jobs or just getting into college, like Discover Card. They're sending out, get a credit card, and they don't even have, paying jobs. But it said 96 baby here, and layaway was still around for us poor people. I think it was around elementary school. Maybe I started noticing payphones and layaways going away. But we aren't that young to not remember these things as kids. Anyway, I think what we're going to learn here in this go-round, in this, what I believe, major recession that's headed our way, is that Debt is bad. I think that one of the things I like about Dave Ramsey, I don't agree with him on his call on the housing market that prices only go up, but I do agree with him, and what he teaches people is to, be out of debt. There's something, they say if you want to be rich, you'll be out of debt. What does rich mean? I think it's sleeping at night and being able to be healthy, not pressured by the mounting debt, that hammer on your head that, when you can't pay your bills. Our next commenter says, where's the help for the middle class? I'm considered middle class, but living in a studio, getting evicted because my landlord is selling. Don't qualify for any low-cost help. Can't find nothing to rent that accepts big dogs, so I may end up on the street because of all this. Now, what I'm going to say is that a lot of people are on the streets because of their dog. They're living in a car. I know that dogs are like family, don't get me wrong, but I'm sorry, when it comes down to a place, a roof over your head, I don't know. That's a sensitive subject, but this comment here is where we are. I think we need to absolutely hope to achieve home ownership, because this is one of the consequences in renting. Your landlord can decide to sell or throw you out. I had a conversation with a client of mine yesterday about, maybe wanting the tenant wants to extend their lease, wants some different terms, some extended terms. And my client was saying, I don't know that I want to do that because I may sell my rental. And that's happening all over America. Landlords are, they're thinking about getting out of the business because it's not the glamour that the Instagrammers and TikTokers want to make it out to be, being a landlord. So, in order to prevent this, right, being evicted, for whatever reason, with the landlord either wanting to switch tenants or wanting more rent or, wanting to sell, I think what we need to do here is, if you're considering renting and you're planning on staying put there for any period of time, I think that you should negotiate a 2-year lease, not a 1-year lease. If you can bake in your increases or negotiate them away to stay longer, that would be something that I would consider doing, and then really focusing on that 2-year period, saving your money, getting rid of the debt that you really don't need, get those credit cards paid off, those car loans paid off, even sell a car if you have to buy a more affordable car that you can pay in cash. But get yourself in a position where you can really start banking and saving, so that if you want to buy a house one day, you would be able to do so. The other thing that kind of piggybacks with that is that you may need to consider houses that you wouldn't have considered before. Something with a payment that you can easily afford. Our next commenter, talking about the John Rubino interview. Great chat, everyone. Was concerned it was going to be a real estate powwow, but you actually hit on real issues. Guys, if you haven't really dove deep into our channel, I'm encouraging you to do that. Go back, look at some of the older videos that we have, because, we do cover a lot. I'm really fortunate and blessed to have some amazing guests on the show that really have a lot more insight on the economy from a macro scale, and that's something that we can learn from it. A lot of the comments that I hear, is about me being a doomer or crash bro or whatever. I'm not trying to be a doomer or crash bro. What I'm trying to do is bring the issues that seems to be glossed over by mainstream media to a little bit more in the light. If it applies to you and it can help you, that's my goal. If it doesn't, and you're doing great financially, then I'm really happy for you. But I recommend go back, dive into some of these conversations. I think that you'll find them, helpful. And the other part about this comment that I want to kind of encourage you, every Tuesday night for over 3 years now, we have been going live at 8:00 p.m. Eastern time. We open up the chat hours before the show starts. We take your comments and questions. We try and do it in a first come, first serve basis. But one of the things that I want to encourage you is be part of our community. Log on, set your alert. If you can, join us on Tuesday night, 8:00 p.m. Eastern time. We're on for about 2 hours. Set your alert, because what you will learn in the chat and the community that we're building is so invaluable. These people really care. We do have the ones that pop off and say things that, are just disparaging. You want to ignore those, but there is a ton of great content and a great community that you can be involved with. It may help you out. And then finally here, recently sold a 3-bedroom lakefront house valued at $225,000 for $120,000. There were over 100 showings and some crazy low offers for $75,000. I would say that the crash is knocking on our front door. Look, we let this thing get way out of control. Seeing a 40% or 50% price increase in housing in less than 3 years is something very tragic in America, in my opinion. We're losing the fact that, these are basic necessities of life. We're more focused on the GDP that is generated and the cash for these banks that is generated on our, high paying, interest that we pay over 30 years. I was speaking with a loan officer this morning. She said and this is a loan officer, said the 30-year mortgage is despicable. It's disgusting. You actually pay 2 times the amount of the house if you keep it for 30 years in interest payments. And she was saying that she tries to encourage people to take 15-year loans. But I think what we're going to see here, guys, is we have to pull back. We have to get this thing into perspective, get our debt under control. And you know what? If you can afford it, you have a great paying job, you bought houses before, God bless you, more power to you. Keep driving whatever it is that you're doing. But for those of you that are on the sidelines, I want to hear from you. You can send me an email, ts@saxrealty.com. Tell me what your situation is. We have a great agent network all throughout the country. If you're looking to buy or even rent, I'll try and team you up with someone that cares about people and that's compassionate the same way that we are here at Sachs Realty. If you like the video, guys, you can hit the thumbs up. It'll let me know that you did. If you haven't subscribed, like I said earlier, please consider doing so now. Smash that alert bell. You'll know every time we upload content just like this. And keep those comments and questions coming. You never know. We may be addressing yours on next week's Real Estate Q&A. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.